Namaste and welcome to part A of ratio analysis under simple solution series. Getting into the basics of ratio analysis. Ratio analysis is a process of determining relationships between different elements of financial statements. It is a tool of financial diagnostics, and the ratios provide a measure of relationship. They define the quantum between two variables or figures, and they are expressed either as a percentage or as a ratio 2:1, 3:1, or times 10 times turnover. The relationship can be expressed as a percentage or number of times and also as a ratio. What's its utility? To understand the cash strength or liquidity position of a company, its solvency as a going concern in the long term as well as in the short term, how efficiently the organization is working, and what is the profitability position of the firm. And when we have two firms, how do we compare them? We can compare them in terms of relevant ratios. And within the company also, between two departments or between two products, there can be an intra-firm comparison depending on cost of sales, gross profit within the departments, and ratios can also help us build up trend analysis. These are the basic elements which contribute to the importance of ratios as a topic of financial diagnostics. For the sake of easy understanding and using the ratios effectively, four groups are formed based on their core feature: profitability related, activity related, related to short-term solvency, and related to long-term solvency. Each of these four groups have got their subgroups which have more micro level of ratios to help us understand each element better. Under grouping of ratios, we have under profitability, gross profit ratio, overall profitability, then net profits, and return on assets, return on equity, return on total capital employed. These are the three ratios of profitability. And financial leverage, for the sake of seeing as to how equity gets benefited with addition of debts and at what capacity we are. This is regarding the profitability ratios. Under activity ratios, all related to turnover, how many times inventory is turned over as related to cost of goods, stock turnover as related to average raw material stock and material consumed, debtors turnover as to how many times the cycle of debtors into collection and sales goes on, average debt collection period, and assets turnover, how many times the total tangible assets of the company have been turned over in terms of the speed of operations. Then we have got short-term solvency, current assets versus current liabilities, liquid assets, quick assets, or acid test. It's the same thing. And interest coverage, how comfortable the company is to meet its interest obligations in respect of current debts. And long-term solvency, talking of fund from long-term funds and equity. Proprietary ratio is how much is owned by the equity holders in the total funds deployed in the company. Capital gearing is in terms of what is the outside funds in the total assets employed in the company. This is an overview of the ratios which are relevant for financial review and analysis of performance and strength of a company. When we go into ratio analysis, we have to understand conceptually as to how these ratios come into picture. For example, we receive a profit and loss account, but the profit and loss account in its original form may not be that amenable for interpretation of ratios. For that purpose, we may have to convert a profit and loss account for our understanding as an income statement, which will have grouping of sales, then cost of goods sold, gross profit, operating expenses, operating profit, non-operating income, earning before interest and tax, earning before tax, and profit after tax. This is a template. If we are able to put the profit and loss account in this template, we have understood very clearly to carry this financial statement through the process of ratio analysis with a lot of ease. Same logic applies to balance sheet also. A simple balance sheet of assets and liabilities gives all inputs, but for a basic understanding, it is better we apply it a template of net fixed assets, investments, liquid assets, current assets, liquid liabilities, current liabilities, derive the working capital, derive total assets deployed in the business, how much is from outside external liabilities, how much is from inside, and what are its components: equity, preference, reserves, capital reserve, profit and loss account, and it should be tangible, therefore deduct goodwill and miscellaneous expenses. To put it simply, both these income statement and the position statement, which are an altered form of profit and loss account and balance sheet respectively, these are the templates which are practically used by every lender, be it a bank or financial institution. They keep this template to put the financial statements of borrowers through this and find out how does it look in terms of ratios, because these two statements help you link ratios directly into the template and understand where does the client stand. Therefore, understanding of the basic templates is required for conceptual clarity. Preparing an income statement is the easy task. It is just a matter of grouping and regrouping items as required to be provided for as an input into a ratio. Just like we do here now, we start with raw materials. Take the opening stock of raw materials. We take the purchase of raw materials. Then we have got the closing stock of raw materials, and we derive the raw materials consumed. Then we take up direct wages, manufacturing expenses, and that gives us, along with the raw materials, the cost of production. And as we proceed further, once you have produced, then you take up the opening stock of finished goods. You take up the closing stock of finished goods, derive cost of goods sold. These each subheads are an input for your ratio. Once done, you have got the sales, you have got the cost of goods sold, you have got the gross profit. This is the flow: sales, raw materials consumed, wages, manufacturing expenses, cost of production. Once cost of production derived, derive what was the opening stock of finished goods, take the closing stock of finished goods, and we have got the cost of goods sold. Then we have got the gross profit. Sales minus cost of goods sold is gross profit. Then we have got operating expenses. What are the operating expenses? Very simple. Administrative expenses and selling expenses. Post them here. And your total operating expenses is 100,000. Your gross profit is 500,000 minus 100,000 gives you operating profit. And out of operating profits, we go for non-operating income and expenses. Profit on loss of shares, 50,000. Loss on sale of plant is 55,000. Net 5,000. And that gives us earnings before interest and tax, EBIT, 3,95,000. Then we have got interest, 10,000 as an outgo. Earning before interest and tax. Before tax, interest is already provided for, 3,85,000. Then we will provide for tax of 35,000 out of 3,85,000 for the sake of completing the format. And you have got 3,50,000 as the profit after tax. Why this income statement becomes important is for the simple reason this input sheet will give you data required for every ratio that you are going to prepare. Even when you prepare a calculation of ratio, you can just visualize as to where does this come into picture. Sales, cost of sales, gross profit, operating expenses, operating profit, non-operating income, EBIT, EBT, and profit after tax. Every ratio has to capture data from this template only. There is nothing outside this so far as the profit and loss account is concerned. Once profit and loss account is converted into an income statement, same logic we have to apply for the balance sheet. From the balance sheet, you first take the fixed assets. And one thing we need to very clear. We take the depreciation and take the net fixed assets for all calculations. And one more point to note is if there is a revaluation reserve, that will also be indicated here so that we have got net fixed assets free from all revaluation effect. Second item will be the investment, long-term investment, not short-term investment. Once that is done, we come into components of liquid assets. Liquid assets means that which can be converted into cash in the short term. Cash, investments of short term, bills receivable, and debtors. These are the four items which come into liquid assets. Okay, along with liquid assets, we have got other assets which go into current assets. What are they? Stock and prepaid expenses. Stock may be stock of materials, stock of finished goods. Then prepaid expenses. When you add to liquid assets these two, you get the total current assets. And then we go to liquid liabilities. Liquid liabilities are other than bank cash credit and bank overdraft, which are immediately repayable. Therefore, sundry creditors, bills payable, outstanding creditors, proposed dividend, provision for taxation. So to say, you can take every item which is there in the current liability and name it under liquid liabilities except these three: short-term loans, bank overdraft, and bank cash credit. Why bank overdraft and bank cash credit? They are repayable on demand. They can be withdrawn at any point in time. Same is the case with a very short-term secured loan. If you take these three, balance is liquid liabilities, and total you end up with liquid liabilities plus this is 540 is current liability. Current assets minus current liabilities is working capital. Our working capital is 930 minus 540, 390. Thus we have got net fixed assets, investments, and item number C is working capital. Then what is the total assets in the business? Total assets in the business is A plus B plus C, 840. Because we have not taken two items which are miscellaneous expenses and goodwill, which we'll deal with separately. These are assets without them. Net fixed assets, investments, long-term investments, and working capital. Total is now. This is called total assets. This is also called as capital employed. When you say capital employed, it is funded by borrowings and owned funds. First we take out the borrowed funds, external liabilities, loan on mortgage, secured long-term loans, 300. Then that leaves us whatever balance is there, that is funded by, it is called net worth, or it is called long-term fund, or it is long-term fund minus external liabilities, or it is called shareholders funds. Means 840 is funded by external liabilities and shareholders funds. This is the debt, this is the equity, and that equity includes what? Equity includes equity shareholders capital. It can also include preference share capital, reserves and surplus, capital reserves, profit and loss account, and from this total we will deduct these two: goodwill, a non-cash asset. Second, miscellaneous expenditure to the extent not written off, that will also be deducted. Net will be 540. All your solvency ratios or short-term and long-term activity ratios all get inputs from the position statement. Simple, what we have done is we have grouped the entire balance sheet into net fixed assets, investments, and working capital. And within working capital, we have struck two groups of liquid liabilities and other liabilities. That will help us prepare liquid ratio or acid test ratio. And current assets is the total of everything, current liabilities total of both. And then we have said, okay, this is the fund deployed in the business. How much from outside, how much from inside? If it is from inside, what does it contain? And that has to be net of the intangible assets. Therefore, net worth, what is called, along with the external debts, leads to capital employed, which is nothing but tangible assets. Tangible assets is nothing but capital employed. It is known as total assets, total tangible assets, which is funded by long-term funds, debt and equity. Now this is position statement. We have learnt about two statements, income statements and position statement. Both put together, when we take it forward, we can understand how to derive the ratios. And what are the four ratios types? Profitability linked, activity linked, short-term solvency, and long-term solvency. Taking cue from those two statements, we can analyze each of the ratios individually and understand from them what they comprise, what they convey, and how it has to be derived. Let us get going. And these are the four types of ratios which are listed out. And for our analysis, we will first take the profitability ratios. In profitability ratios, take gross profit ratio. What does it contain? Gross profit ratio is gross profit divided by gross sales. Gross profit from the income statement in our case, and sales is for the net sales in the beginning. So simple, means gross profit ratio is gross profit by gross sales, net sales. Then what does it convey? It indicates the overall limit within which a business must manage its expenses. What does this mean? Gross profit is the funds which the company realizes after meeting its cost of goods sold. Out of this, The company has to meet its administrative expenses, its marketing expenses, its interest, and it should generate profit. Under no circumstance the cost or expenses of the company can go beyond gross profit. The moment expense crosses gross profit, company is into loss. Therefore, it says the ratio indicates overall limit within which a business must manage its operating expenses. If operating expenses is greater than gross profit, it is loss. The ratio that we take now is overall profitability ratio, which is operating profit divided by capital employed. Operating profits is profit arising from the operations of the company directly. As we see here, it takes care of operating expenses of administrative and selling. It takes care of cost of goods sold, and it considers net sales. This is a reflection of performance. Capital employed is total value of all assets, net of intangible assets and miscellaneous expenditure not written off. We call it as capital employed or long-term funds. And what does it mean? It measures overall profitability of the company. It considers direct and indirect costs. Direct costs, these are indirect costs. What is incurred here as wages, manufacturing and raw material are direct costs. A higher ratio represents a positive return in the company. That is for overall profitability, and we know how to derive it. Then comes net profit ratio, that is profit after tax, PAT, divided by sales. Where do we get profit after tax is, we have from operating profit, we provide for non-operating income and expenses, we provide for interest, we provide for tax, and after everything the net result that we have is profit after tax, and it is net sales. Net profit ratio or profit margin is nothing but PAT divided by net sales. What does it convey? This talks of the efficiency with which the business is being run. Means if you save on these expenses, if you improve the gross profit, if you save in interest, if your tax is minimum, in that case everything gets built into profit after tax, which as a percentage of sales will be quite impressive. That brings us to next one, return on assets. Once again, it is PAT, the bottom line, we call it as bottom line, which is profit after tax. On total tangible assets, as we said, entire funds which is invested in the company, excluding fictitious assets and goodwill, is capital employed, and PAT is nothing but the profit after all things out goes tax. And what does it indicate? How effective the company is converting money into net income. A higher return on assets means the company is earning more money on less investment. Higher percentage of return means small amount giving big returns, more than normal returns. Then comes return on equity. Once again, profit after tax divided by average shareholding funds. Now, when we are having one balance sheet, we may have to adopt whatever figure available therein. If you have got the opening balance of capital, then you may have to take average of the two. In our case, shareholders funds is nothing but total capital employed less external liabilities. In our case, it is a figure of 540, which comprises all these things. And that is the return which the equity holders will be getting it. This is an yardstick of performance for equity shareholders. because it is a return on their funds. This entire PAT belongs to them. It doesn't belong to the lenders, because lenders have already been paid interest. What these people will get is interest. Whatever balance profit is there after interest and tax belongs to them. Therefore, it is return on the funds employed by them. Then we have got this particular ratio, return on investment. You should focus on this for the simple reason it is a product of two ratios: profit after tax divided by sales, which is nothing but net profit ratio. Second, it is sales divided by capital employed. Capital employed is also known as tangible assets. When sales is divided by tangible assets, it gives to asset turnover. When you take both these together, it is nothing but net profit ratio into asset turnover. Go a step forward. There are two formulas, one multiplying the other. There are one item which is common in both, one in the numerator, the other in the denominator. When we strike them off, what remains is PAT divided by capital employed. This is how. Now, what does it mean? Net profit ratio talks of the size of operations. Is it a small wheel which covers a small distance, slightly bigger wheel, or bigger wheel? Net profit ratio, profitability, whether it is high or whatever it is. This is the rate. And asset turnover talks of the speed. If you take a bicycle, wheelbase is net profit ratio. That is the capacity to run. How speed it runs, that is known as asset turnover. When the size of the wheel is having the advantage of speed, it is nothing but net profit ratio into asset turnover, which leads to PAT over capital employed. This invariably illustrations give this particular ratio because it is a combination of two ratios. We need to be very clear as to how we are building this. Sales and capital employed. The profit being the net result of all operations. ROI expresses all efficiencies. It talks of product profitability. What is product profitability? Net profit ratio. And it also talks of product turnover, which is nothing but asset turnover. This is an important ratio and its components are worth understanding. We have got last one, financial leverage. Earning before interest and tax divided by earning before tax. Means this is without interest, this is after paying interest. Both are available. In our case, it is 395 and 385. What does the formula say? As interest is a fixed expense, this leverage, this is called financial leverage. A higher degree of financial leverage means higher return, but higher return means higher risk. A company should have a decent EBIT by EBT so that it has got moderate return and moderate risk. And this helps decide the mix of debt and equity. These are all pertaining to profitability, and that leads us to take up ratios in the activity level. Under activity, it is all pertaining to turnover, means sales is one of the components. When there is not sales, it is cost of goods sold. Inventory turnover means cost of goods sold divided by the average stock of finished goods. Average stock of finished goods means opening stock plus closing stock divided by 2 in respect of finished goods. What does it convey? It talks of if inventory is moved fast, liquidity of inventory, brisk sales. A lower inventory ratio means slow movement. A higher inventory ratio means there is faster turnaround and faster generation of cash. We have the second ratio, stock turnover ratio. Stock turnover ratio is raw material consumed divided by average raw material stock. Same logic. Third is debtors turnover. Normally, debtors is from only credit sales. Sales divided by debtors. We presume we take credit sales only. Here we presume full sales to be credit sales. Sales divided by debtors is debtors turnover. A higher debtors turnover indicates collection of receivables very efficient and quality customers who pay their debts quickly. If the turnover is less, means the money is struck. The fourth is average debt collection period. This we will take the average debtors, but average sales per day we have to derive based on, in our case, it is 10 lakh sales per annum. We have to find out how much is the credit sale and what is the credit period. What is the number of days of operations? We have to take that average sales per day to derive what is the average debt collection period. Means for how long the money is struck with the customers. And asset turnover, sales divided by tangible assets. As we have seen, tangible assets is once again the same figure which is capital employed. And goes without saying, the higher asset turnover ratio, more efficient a company is at generating revenue. We aim at faster and let us take current ratio now. What is current ratio? Current assets divided by current liabilities. Current assets include liquid assets and liquid liabilities. What does it indicate? Current assets are to be funded by the company as well as from outside. Where the company puts more of its money into current assets and borrows less, it will be a higher current ratio. Your assets, if they are 2 and if you have borrowed 1, and your ratio will be 2. You have put your money into it. Only 1 you have borrowed, 1 you have put your own money. When will a person put more of his money into current assets? When he has no other better investment opportunities. Therefore, it says a higher current ratio would indicate inadequate employment of funds. On the other hand, you have got current assets of 100. You have borrowed entire 100 from outside. The ratio is 1:1. This is quite dangerous because it is a signal to the management that they are at the mercy of lenders. They don't have enough money to put into current assets. Current ratio is a double-edged sword which has to be properly guarded against. Our money should be there in current assets to the extent we cannot borrow effectively, but at the same time, it should not be suffering from idle cash being kept with the company, and which suggests absence of alternative investment opportunities. This is a reflection of how the day-to-day management of liquidity is made by the company. Then comes liquid quick acid test ratio. It can be either of these three, and quite simple. Our definition of liquid assets: all current assets excluding stock of raw materials, stock of finished goods and prepaid expenses. That is called liquid assets. Liquid liabilities, all short-term liabilities excluding bank overdraft and short-term loans. If you exclude this, you have got liquid liabilities. Liquid assets minus liquid liabilities or divided by liquid liabilities is liquid ratio, quick asset ratio, or acid test ratio. What does it convey? It talks of short-term solvency. And if you compare current ratio with a quick ratio, If you take current ratio and quick ratio, what is the difference in the current assets? Liabilities might remain the same. Difference between a current ratio and a liquid ratio is what is excluded from liquid assets is the raw materials. This we have to use in certain illustrations where the two ratios are given and we have to find out the stock. Now let's get into interest coverage ratio. Interest coverage ratio talks of profit after tax plus interest. In our case, it is 350 plus 10,000, 360,000 divided by 10. 360 divided by 10 is 36 times. What does this indicate? A higher interest coverage ratio indicates stronger financial health, and it is used to determine how easily a company can meet their interest commitments. Then we are into long-term solvency. Long-term solvency, we start with debt equity ratio. Long-term debt divided by shareholders funds. From the position statement, long-term funds are nothing but external liabilities. Loan, mortgage, secured loans divided by shareholders funds is nothing but net worth. It is talking of how much the company has borrowed and how much the company owns funds. That is the debt and equity. And what does it indicate? It is the proportion between outsiders funds, this is outsiders funds, and shareholders funds. In the capital structure of the company, it talks of promoters holding versus borrowings. That decides the control over the company. This ratio which we are talking of is proprietary ratio. Proprietary ratio means shareholders funds divided by total tangible assets. Effectively, it means how much of the tangible assets are funded by the shareholders. And it's a variant of debt equity ratio. Spirit is the same. How much you hold in the company, how much external people hold in the company. Tangible assets. Third one is capital gearing. Long-term debt divided by tangible assets. Capital gearing, once again, how much you have borrowed against your assets. Your total assets are 840. You have borrowed 300. Long-term debt divided by tangible assets. It's a measure of financial risk. The more you borrow, you have got more of risk of repayment of principal and payment of interest unless the business is able to generate that amount. Thus, we have seen profitability ratios, activity ratios, short-term solvency, and long-term solvency. And to summarize, having the ratios, we prepare or we refer or conceptually we are clear where does it appear in income statements, where does it appear in the position statement. And for each of this, numerator and denominator in every component of ratios. As you have understood now, everything is covered in these two statements. Thank you so much. Thanks a lot.